Now it is. Hey! How's everybody? All excited? Ready to rock and roll? Look, we have a great panel today, but I'm really excited to be here just to highlight all the good work that's going on right now to accelerate the deployment of clean energy across the United States. Look, last year was the best year ever for clean energy in the history of our nation. This is exciting. So how'd that happen? Well, smart federal and state laws and policies sent clear signals over the past 2 years that the United States is once again open for business. That's what we're going to talk about today. That's why after leaving public service, I joined Pegasus Capital Advisors, TPG Rise Climate, and Bloomberg Philanthropies because I knew that climate change wasn't just a domestic issue, it was a global challenge. And we would only succeed in ensuring our children and grandchildren had the future they deserve if we attract private capital investment at scale. That's what 2024 is really all about. It's about climate finance, because this is the year that the public and private sectors must partner and work together to put the world on the kind of trajectory we need that is going to be aligned with the climate challenge and our climate goals. You know, COP28 led to more than $85 billion in commitments to climate finance, which of course is helpful and it's also very hopeful. But after all, it is a lot of money, but until you compare it to the funding climate change demands, it is simply not enough. So we have to move fast. We have to attract and scale up additional private sector investments that is enticed by the opportunity for reasonable rates of return that could capitalize all the needed investments that would strengthen our local economies, that are going to increase food and water security and build our country and community-wide resilience to climate impacts that, frankly, none of us can ever any longer avoid. Particularly, we need work in emerging markets and across the global south. That's what we have to do if we want game-changing change that will match the challenge that we're facing. You know, while countries all across the world are working to find the best model for them, in the United States, we now have tax incentives for businesses who are willing to invest in clean energy manufacturing and in heavy industries, so that we can reduce the cost of our goods and services while our consumers have access to rebates and other strategies that have opened up new avenues that are enticing significant private sector engagement. Look, the passage and implementation of the Inflation Reduction Act has created just an unprecedented opportunities in both blue and red states. Frankly, even more in red states than blue states. Communities across America and beyond are investing in clean energy because it makes their lives better. It allows them to have stronger economies while reducing our reliance on fossil fuels. So while it's true the interest rates have been challenging, they're coming down. Yes, there has been supply chain disruptions, some anticipated and others not so much, but that hasn't stopped us from having a hugely successful year in renewable energy investment. And next year it's expected to be even better. In fact, the trend line keeps going up. You know, these kind of results, they don't come by happenstance, just a happy occurrence. They come because people worked hard. They come because we had an administration that played a pivotal role in providing investment incentives through the Inflation Reduction Act, the bipartisan infrastructure law. And these investments really have opened the floodgate for renewable energy investments all across the United States. Billions of dollars have been invested and are heading to states all across the United States as people see what the clean energy future can deliver for them, for their families for our shared economic stability. Globally, the U.S. is now the second largest investor in the energy transition, more specifically in renewable energy, upgrading and expanding the grid, electrifying transport and heat and cooling. All of this was done because of the Inflation Reduction Act, which was passed in August 2022, just about 1.5 years ago, and it has unlocked more than $352 billion in investments across 47 states and Puerto Rico. We are talking about more than 250,000 new clean energy jobs that have been created, including 105,000 jobs in low-income communities and 43,000 in rural communities. So this was done eyes wide open, and it is working. It's working for all of us, not just those in states that can afford it, but it's in areas that need the investment more than anyone else. So simply put, this clean energy transition is on steroids in the U.S. We have public sector dollars that are attracting private sector investment. And while the IRA is just getting started, because it's only been 1.5 years and it has a 10-year horizon, it's no longer an experiment. It's a testament to the value add when the public and the private sector work together, which is exactly what must happen across our world, most notably in the global south. So right now, I am managing co-chair of America is All In for Bloomberg Philanthropies, and I have the pleasure of interacting with governors and mayors and private sector partners and others, and they are all leading the charge on climate change. Look, we have Nevada that's become a central player in battery and solar manufacturing. We have New York, which has become a key hub for offshore wind and battery manufacturing. And in North Carolina, they're becoming a hub for EVs and transmission manufacturing. And the list goes on and on. So we have a lot to celebrate, but we also have a lot we need to do together. So let's focus on sending clear market signals that the transition to clean energy is here to stay and that we have to all work together, because the simple and undeniable fact is that solutions to climate change are already available. Let's make them work. Let's accelerate them at the pace that climate demands, because if we will, we'll give our kids and our grandkids, especially mine, a reason to believe in us again, to say we did it. Let's do it. Thanks very much. All right, now let's have me turn to Rich Powell, the CEO of ClearPath. He's going to actually kick off this fantastic panel. Thanks very much, everybody.
Thank you so much, Gina. I'm Rich Powell, I'm the CEO of ClearPath and ClearPath Action. I am absolutely delighted and excited to be here for this conversation with this dream team from climate and clean energy finance with decades. I was going to say centuries. I think I'm going to say decades, many decades of clean energy and climate finance experience. First, I do just want to thank, as always, the Aspen Institute, both the Aspen Ideas team and the Aspen Energy and Environment team for pulling us all here together for this amazing week. This is my third time for Aspen Ideas Climate here in Miami, and it's just such an incredible convening with incredible people, and thank you all for being here. So I'm going to start by introducing our dream team, and then I'm going to ask them all one question to get us started. And so just going down the line, first we have Kojo Akuasari. He's the Managing Director for Decarbonization Partners, a joint venture of BlackRock and Temasek. Then we have Libby Wayman, a partner at Breakthrough Energy Ventures. Then Lauren Faber O'Connor, an operating partner at Lower Carbon Capital. And last but certainly not least, Richard Kaufman, the chair of Generate Capital. What a time to be having a conversation about clean energy and climate finance. What a wild year in this space. So everything that Gina said is very true. We have had a remarkable year of new project announcements and new capital formation. It was recently announced we had the largest year ever in the build of new renewables, particularly new solar and battery storage projects, although wind had a rockier year, and we'll talk about that. We had massive investments in carbon management technologies, huge acquisitions of new CO2 pipeline networks and carbon dioxide removal projects, and huge investments nationwide in clean manufacturing facilities as well. And it was a best of times, worst of times. We had continuing strong inflation and supply chain chaos, high interest rates. We saw waves of project cancellations, particularly in some very high CapEx, low OpEx situations like offshore wind and new small modular nuclear plants. Multiple firms attempting to enter some of the capital markets also had either cancellations of their SPACs or firms that had entered the markets through SPACs saw really rough years in the markets. So with all of that, what a time to have a conversation about the road ahead and where we're going to go. And so I'm going to start by going down the line and asking everyone the same question. Given everything we saw this year, all of these challenges in market conditions and the continuing strong interest in all this, how long will this environment persist? We're asking everybody here to predict the future. What's it going to do for your portfolios over time? And based on that environment, how are you responding? What are your emerging preferences in this space? So, Kojo, can I start with you?
Yes, you can.
I think we're already on. I think you just hold it right now. There you go.
Yeah, very good. So how long? At this point, I think this is the new normal. I think the transition to a cleaner economy is here. It just is more of a question of how fast. We're past the point where people would ask themselves, is this real? Is this, fantasy, or is this something for the academics? And we're very much into a place where people see it as real business models. I came into this space a long time ago, back when I worked at Google, and I always like to point to two numbers that really show how much the world has changed. One, in 2011, solar PV was $4 a watt. Today, now it's about 20 cents a watt. And so what that means, in some places, inclusive of the capital expenditure to put the PV in place, considering the solar resource is appropriate, the energy is almost free. And so because the cost of the panels have come down so far, it's not only is it the panel business continuing to grow and the margins continue to shrink because financial folks are going in there and they're helping kind of continue the growth, but they're also seeing new businesses come to play. It's like, how do I monetize this new low-cost energy? The other number I like to point to is in that same time frame, kilowatt hour of lithium-ion battery was $1,300 a kilowatt hour. And today we're around $100 a kilowatt hour on our way to basically a little bit over the price of the metals inside the batteries themselves. And so when you actually have components of this new industry coming down in cost as fast as they are, it not only makes those industries work well, but it unlocks a whole bunch of other industries. And so I think this is a new normal. It's just a matter of how fast. As it relates to our portfolio, we continue to look for companies that are clearly decarbonizing our planet. We're a global franchise. We have offices in Singapore, New York, San Francisco, and London, and we make investments across the globe. Way we're looking at things is we fundamentally are trying to insert ourselves at an inflection point, the commercial inflection point of decarbonizing companies. And so for us, because of all the work that's been done to date, we think there's really an immense opportunity. And to be quite frank, you mentioned the SPAC market. I think a lot of people didn't appreciate how much value was embedded in these technology companies until the SPAC market occurred in 2020. And a lot of would-be hardware businesses that were struggling to raise capital all of a sudden were multi-billion-dollar businesses. Now, some of them came out too early, but a lot of them didn't. And now there's a clear understanding that this is a real opportunity. And so we, with a bunch of our peers, are also looking to accelerate the market for clean opportunities. And we think there's a very bright future.
Libby.
Yeah, it's great to be here with everyone. So glad to have these couple of days focusing on these really important topics. So where are we in the investment landscape for climate tech? I think people are really focused on the contraction in the market in the last few years. But if you take a longer view over the last 5 years or 10 years, this is actually a great time to be an entrepreneur and innovator in climate tech and clean technology, because the 5 and 10 year trends of investment in the space are up and to the right. And we had a little bit of an anomaly over the last couple of years that Kojo mentioned, where public markets were very enthusiastic about the trends, rightfully so, but maybe a little too enthusiastic in the short term. And some companies came out too early, and that impacted the private markets as well, where really large investors were trying to come into the private markets earlier than they normally do. And so you saw companies able to raise really record amounts of capital, and that's come down in the last couple of years. However, the long-term trend is still increasing. And if you look at the deployment side, the complement to the cost declines is that we're at all-time records on deployment of wind, solar, and batteries. And those are the first couple of technologies to come out of the gate. And we'll start to see that in other innovations that are maturing and ready to enter the market. So what does that mean for how long this will last? I think this is a long-term trend where we will see increasing deployment of clean technologies. It will go beyond solar, wind, and storage into the next technologies that are maturing. And we will see increasing equity into the sector. And there will probably be some ups and downs. So what does that mean in terms of how we're focusing and how we encourage entrepreneurs to focus? It's really focus on the basics. Make sure you have very strong core value proposition. You focus on that proposition, that value proposition, what you can do better than anyone else in the world, whether it's a core technology or capability, and that it's defensible, and that you set yourself, either your investment or your company, up for long-term success. So if you're raising money, make sure that you bake in the long-term capital trajectory, even if you're able to raise a lot of money at a really, really high price early on, for example. Think about how that will manifest over the next 5 and 10 years. Make sure you set your company up for long-term success. And that's the strategy that we take on the investment side as well. And so we're optimistic about where this market will go in the long term, and we're seeing a lot of great innovations still coming to market, and a lot of great entrepreneurs who are very mature in how they think about building their company and bringing their technologies to market, and we're excited to partner with all those entrepreneurs and companies.
Lauren.
Thank you so much. It's wonderful to be here. This panel really represents sort of different stages in some ways of a company's growth, a clean tech company's growth. And so I think that's important to recognize as we're all sort of diving into the world of finance and sort of the earlier stage of new climate tech companies through, as Kojo was talking about, that inflection point of growth all the way into infrastructure and projects. And so if we think about everyone's role in this question, for us at Lower Carbon, we're really looking at, what are these civilization anchoring technologies and businesses that they're being built right now, and they're going out into the future. So today's disruptions are as if look, thank goodness I did not throw away my bell bottoms back in the day, because they are back. And so, when you're in this for the long term, this is background noise that can have a real impact. But at our stage, it's somewhat background noise, because ultimately, these are the businesses that are going to run our economy. And so we are seeing at early stage companies that will have outsized returns in the long run. So we continue to kind of follow the basics, a little bit of what Libby was saying in terms of focusing on the core technology and the most badass, intrepid, founders and technologists who understand where the market is going and where the technology challenges are breaking down. The smartest people I've ever interacted with now in this role. And so ultimately, that's how we continue to see ourselves and the role of our portfolio, the role of our investments, that our investors see us as that way of finding those companies. And it comes down to the long-term relationship and investment that we end up having.
Richard.
Well, thanks, everybody. Is it working? Great.
You're working.
So, Lauren, I appreciate the call out to talk about that we represent different investing or financing silos. So, Generate Capital owns and operates sustainable infrastructure, And so maybe I can give some specific comments about that. And I'm really not going to forecast the future either. I agree with all the other panelists that the tailwind's very strong. But I would say that there are a couple of lessons that came out in the last couple of years that are worth talking about that really represent, I think, some necessary stages of maturation and how money gets invested. So, we talk about interest rates. Obviously, interest rates increase the cost of financing. But the thing about clean energy projects is that they're much more capital intensive than fossil plants because the operating costs are very low. So they're incredibly sensitive to increases in interest rates, I think in a way that I'm not sure that a lot of people really appreciate it. And so it's a little bit for those that are in the bond market. They really act like long bonds in the way that they're valued. And when interest rates go up, the value of long bonds really plummet. So that's sort of one lesson that I think the market had to learn. But the second thing is that I think a lot of people that invested in infrastructure assets thought they were really like long bonds in the sense that there was very little risk. And it's true relative to investing in a venture, there is less risk. But there's no question that there are operating issues associated with even mature technologies that are operating. And I think that was also a surprise. I think the other lesson, and Libby talked about this, is this Kojo as well, about this point about public and private markets. The industry relies historically on private markets for financing, which is different than other sectors of the economy, frankly. And so when we look at private markets, that means we have to look at funds. And just to give you a statistic that somebody gave to me the other day, that there are 570 funds that are infrastructure energy transition funds trying to raise $500 billion. And 2/3 of those funds have been in the market for more than 2 years. And so it's been really, really hard to raise money. I think the high water mark for those kind of funds is $160 billion. And so one of the things that happened is when the stock market went down, the people that own portfolios, it meant that they could not allocate as much. In fact, they had to reduce the allocation in terms of private markets because the private market allocation in portfolios of big institutions is smaller than public markets. And so that's the exposure to private markets, I think, also was something that came out. And the last point I want to make about these funds is because when a developer develops a project, so we think about these great innovators that are going to develop technologies. Eventually, they're going to deploy these technologies in the form of projects. All the developers have to think about who's the long-term holder of these capital assets. Maybe they have 15 or 20-year average lives. Who's going to be the lowest cost form of capital? Because the lowest the interest rate, the highest value. And we still haven't figured out what that number is, and that's very dependent on how much money winds up going into infrastructure funds, because those tend to be one of the lowest forms of cost of capital.
Libby, I'm going to come back to you, especially for folks in the room that are not in finance. I think a lot of this can seem very abstract. I'd love for you to sort of take this down to the sector level, the subsector level, even the company level, and just sort of walk us through how you, at this point at BEV, are thinking about where to focus, which sectors to focus, what stage of maturity for these companies.
Sure. So Breakthrough Energy Ventures is an investment platform focused on really the earliest stages of investment, starting as first money in. We often also co-found companies with innovators. We also often build companies internally and then bring in subject matter experts to lead those companies. So we are extremely early stage investors. And to Richard's point, we, are very different types of funds, and thank you for calling that out, and Lauren as well. And we don't really have a single sector focus. We invest in anything across the economy, and our first filter is what can make exceptionally large impacts on reducing carbon emissions and addressing climate change. And out of that subset of opportunities, we look for excellent return potential. And I think we share a thesis with everyone on this panel that companies that can drive that kind of impact represent the opportunity to build an extremely large company and lasting value. So bringing that down yet further, rather than talking about a specific sector, what we'll do at the very earliest stages is we look for very big markets. We look for an opportunity to introduce, there's usually an innovation at the core of being able to deliver value. It's usually, in our case, a technical innovation. It doesn't have to be, but that's what we often find provides a long-term differentiation. And we size the opportunity based on the market size and that differentiated value a company can bring. And then we look at what kind of capital will be required to build that company over time, and how many other investors we need to bring in. And at the end of the day, we can see how value accrues to everybody involved over time, and looking at the exit potential based on the market size and the value that they bring to the market. There's one other piece that's not represented on this panel that I think is a very important stakeholder to this sector, and that is kind of off-takers of whatever the product is. And in energy projects, there's this amazing innovation called the power purchase agreement, which is basically a 20-year, or now longer in some cases, firm contract to offtake the product of whatever project the technology gets implemented in. That's pretty unusual and pretty unique to the power sector. And I think if we want to see some of these other innovations come to market, they'll often be manufactured products, whether it's a fuel or another commodity, a material, a metal, and it's very unusual in sectors outside of the power sector to have such long-term offtake agreements. And so that's another really important stakeholder in this mix. It's private capital, it's public markets capital at the kind of end of the day. It's the public sector in terms of state and federal governments. And then the corporations or the customers that want to see these products, they also have to take a little bit of risk and go in with the innovators. So I just wanted to call that out too as another element that we look for and we try to build toward in that trajectory. And I'm sure that's something you guys look for when you get involved.
Could did you want to weigh in on that?
No, she captured it exceptionally well. I mean, there are a lot of different things that go into kind of decision making over at Decarbonization Partners, but we're a couple of stages downstream from the folks here, Lower Carbon and BEV, and we're upstream of Generate. And our kind of really inflection point for us after these guys have done their wonderful work, is whether or not the company is ready to really start scaling. It's building their first of a kind factory or rate production on whatever widget they're building. And so in many ways, we're the bridge capital between the venture dollars and the infrastructure dollars, because oftentimes, and Generate is actually exceptionally innovative, but oftentimes infrastructure dollars are unwilling to take first of a kind risk. And so that's still, for stepping out of the finance world, there's different layers of dollars you can deploy to grow a business. And typically, when the company is relatively new, it comes in two flavors: equity and debt. Debt gets a cash payment no different than a mortgage, and equity is the other side of that, where you're the owner. And as companies continue to mature and they demonstrate commercial viability, then they can start doing very clever things where they'll say, okay, this piece of my business and only this piece of my business I will finance. And that's typically where infrastructure folks come in. And so to get a company from where they are just this binary debt or equity place to where they can start carving out pieces of their business, that's where we typically invest and really help accelerate their businesses. Because when you start getting to places where you can finance just pieces of your business to the point that Richard brought up, it lowers your cost of capital, which then provides more capital and cash into the business, which ideally would allow them to accelerate the growth of the business.
So thinking about this moment, this sort of commercialization moment, obviously customers are very helpful. We also have now significant support from policy for many of these things. So clean power, for example, now has the benefit of a tech neutral tax credit, for example. Maybe Lauren, I'll start with you on this. I mean, how do you think in that commercialization moment about the importance of policy and sort of the blended approach where you're going to have customer demand, ideally long-term firm demand, but then also supplemented by policy? How does that play into what you're looking at?
Yeah, I think a lot about the commercialization side of the of the business, and I mean, savvy companies are going to scoop up as much, as many subsidies, incentives, grants, and figure out how to orient a business to take advantage of that. And so, yes, do that, and we want to see that. But at the same time, in terms of reading tea leaves, we actually believe that these companies can and should be able to, stand on their own. So when we're looking and making our investment decisions, yes, those incentive programs and opportunities for additional funding from the public sector, very exciting. But ultimately, we're looking at it as a standalone business with or without those policy that incentive framework. Now, I just want to double underline what Libby was saying about the demand side, because in terms of signals, yes, understanding that there's incentives available is an important signal, but the commercial traction, the ability to understand who your market is and engage with early actors who are willing to take a little bit of risk, but ultimately not so much tech risk as much as just kind of the commercialization side of things. That goes a really long way, we see, as our companies are growing, and we see as they're beginning to access other forms, newer forms of capital, that really being able to show that there is a customer on the other side is so key. And I'm not sure how much the demand side of the equation, corporates or other potential buyers, public sector can be a buyer too. The federal government's doing a lot of that now. I'm not sure if they necessarily appreciate the amount of influence they can have in the growth of a company just by being able to demonstrate that demand. That's very empowering. I think it's they should be taking up that mantle, because it's a huge, huge commercialization unlock to be able to go to an investor or go to a bank and say, we've got this. That's why the PPA model was so great. But if that PPA model doesn't exist, there's other forms of commitments that buyers can make. And there's efforts around buyers alliances in different sectors, in aviation fuels, in maritime, in some industrial materials, cement, steel. That's happening, and those are going to be key. But the members of those alliances, or the folks that are doing it on their own, have an incredibly influential role to play.
So I think that this was also a year when we started to see climate finance, clean energy finance really start to grow up, and just multiple additional sort of levels. Kojo, I'll come back to you on this. So just thinking about the scale that a BlackRock, well, first, can you describe the scale that BlackRock and Temasek sort of bring to this? And then what does it enable you to do on the later stage private equity side?
Yeah, so just to finish it off, so Decarbonization Partners, we're a $1 billion plus fund. We just crossed our 2-year mark, so we're relatively new. And we're in a growing pool of late venture, early growth stage climate investors. I often point, because I had multiple roles. I was at another investment shop before this. I built Google's infrastructure business. I often point that, the catalyst for this specific category of growth was really triggered by, in my estimation, by the SPAC boom. And what do I mean by that is, if you just zoom out for a second, I will get to your question. If you just zoom out for a second, if you think about the past 2 decades of wealth creation in this country, everyone just think of a company. I say Google is one. The other one's Facebook. And if you go down the list of the ones in your head, outside of Tesla, most of them are software companies. And what does that mean? That we've built in a financial system largely around funding and growing software businesses. And the benefit, for those of you who don't know, the benefit of software, it's really easy to, once you've demonstrated market traction, it's really easy to grow, right? You're just replicating zeros and ones. And if you make a mistake, most of the time you make a mistake in a software business, the customer doesn't know. You just give them an update. Everyone has their app store. Hey, app store, we're crushed some bugs or something, whatever, right? And that's them actually fixing the errors that they have in your system. You don't know, right? Apple is clever in that instead of where the PCs have the blue screen of death, your Apple machine just resets. And you're like, oh, it must have been me. No, it was Apple, but made you think of it. So fast forward to the hardware space, hardware reemerges because climate is really replacing dirty machines with clean machines. And we have a system that has really pulled capital together. Capital formation has really come together really around the software world. And so you have enthusiasm at the early stage. There's always someone who cares about new innovations, ways of making the world better. And those get tremendous amounts of funding. Right when they get to this inflection point where they need to build their first factory or they need to build their first project with their technology, the capital thins out. And if the company is able to continue to grow despite there being a dearth of capital, right before they're proven, they have all the offtake that we discussed here, then they go public, and everyone knows that story. It's been in the news for decades. And so that period from where the early stage capital basically thins out and where the public capital shows up has historically been called the Valley of Death. And historically, who has funded in there has been strategics. And that's because for them to get, they're generally in low margin businesses. They're usually in like ones or twos. You think you're Pepsi and Coke. And so to get advantage over their peers, they either invest in their own R&D teams or they just go out and buy a company. And that acquisition can be an outright acquisition, or it can be I'll put a toe in the water, I'll finance the growth of a new idea, and if it takes off and matures and blossoms, then I'll buy the whole company. And so climate is, in the urgency of our problem really doesn't allow that model to work, because that's the reason why we're here, is the technologies kind of stall out, and every day the world's getting hotter, and every day there's more and more carbon in the atmosphere. And so to meet the moment, we need other models. And so I point to the SPAC boom because that really revealed to a lot of folks, probably a meaningful portion of people in this room, that, oh, wow, there's a climate company that I didn't think was a climate company, and has a multi-billion-dollar business. Whoa. Oh, there's another one. Oh, there's another one. That's a whole sector I completely missed. And since then, and mind you, the boom, the people financing into the SPAC market, they made their money, and then that's not really an active way of financing a business. But since then, a lot of folks, okay, maybe we can be more disciplined in how we deploy capital into this market. And that has led to you're seeing a growth to the point that you highlighted of kind of folks coming in at its growth stage to really drive dollars into the marketplace. And so with that said, I am exceptionally bullish on where we're going to go from here. I think there is a lot of education that we need to do going forward, but I think we're moving pretty fast. Is there room and opportunity to move faster? Sure. But I feel very good about the direction we're heading in.
Richard, can I come to you? I know you've thought a lot about this question. We're using these traditional models for an entirely new sector. You mentioned earlier the really high CapEx, low OpEx dynamics. Like, how do we adapt to this new sector? How do we adapt finance to this
Well,
new
I think we are adapting, and this stage is really a good example of how things have changed. Because what we've been trying to do is to finance clean technology through investing or financing silos. Investing and financing are two halves of the same coin, right? We've been trying to finance clean energy through silos that were built to finance other things in the economy. And so and when you think about, look, there's no financing problem for a company that has a big balance sheet. They have plenty of access to capital. But when we talk about innovators or other people that don't have balance sheets, What they need to do is to go from silo to silo to silo to get financing, and each of these silos weren't built for what they were trying to finance. So the historical venture capital business model was not favorable to investing in things that used a lot of capital and took a long time to come to fruition. But now we have a couple of examples here on the stage of new firms that are actually willing to take that kind of risk. But that's the exception, not the rule. When we think about growth capital, that was largely absent in the market. And so the biotech world, many of the same issues in terms of the amount of capital and how long things take to go to market, they haven't had problems being able to get through the valley of death. Well, why is that? Well, there are growth investors. Growth investors typically are willing to take either technology risk or market risk. So obviously in the case of biotech, they're taking technology risk, but they're not taking market risk if you come up with a cure for cancer. But in the clean tech space, historically, we've been asking growth investors to take both risks. And one of the things that's changed, back to Lauren and Libby's point, is now there's a market signal so that investors can take some market. Growth investors are willing to come into the market because maybe they're taking some technology risk, but they know now that there's much less market risk for what their product is. But then when we go to project financing, project financing was never designed for small projects, never designed for projects that had technology risk, because it's all non-recourse financing. It's all based upon a series of contracts. And so we've been trying to, fit deployment of projects into a financing structure that wasn't designed for it. And then, as I said before, we've been relying on private markets as opposed to public markets. So the good news in all this is that things are changing, because ultimately the investing business is a business. The people that run money are doing it to make money. And so there's always been plenty of capital. And so the asset management industry has been acting very rationally, not having much funds and stuff being dedicated to it because there hasn't been an opportunity to make money. Now with the perception and the reality that there are very attractive potential commercial markets, the asset management industry is responding, and it's changing these investing silos. And then I'm just going to say, maybe two final points on this, because you're all thought leaders in your own way. We have had historically a perception that, that we have to lead on technology, that somehow we'll innovate our way out of this problem. And of course we need to have more technology, no question about that. But you see the value of the other way around, which is to also be able to demonstrate the value of the end market, commercial market, and how it attracts capital, and then it also attracts innovation. Because a venture capitalist is not going to invest in something unless they know that there's the next phase of financing in terms of growth capital, and they in turn also know what's the lowest cost of capital for the deployment and infrastructure. Because even though we all represent individual investing silos, the way we get this done is by having a line of sight through all of them.
So when we were preparing for this panel, we thought it would be useful to try to make this very real by talking about some specific investments. And so one that we spoke about that a number of you have invested in is called Antora, which, well, I'm going to let other people describe Antora. It's a very cool company. If you don't know Antora, look up Antora after this. I know at least y'all three have invested in. Who would like to start? Can someone describe to us what Antora does and maybe why you all have invested in it and where and how you've seen it progress through these stages we've discussed here?
There's somebody from Antora here.
What's that? In the room? Yeah. Raise your hand.
I know he's at the conference.
Okay.
David is here.
There we go. There's David. Perfect.
All right.
So everyone assault David after this, but we're going to talk about you, sorry, as a case study.
Happy to. Do you want?
Go for it.
Okay. All right. right, David, here we go. Okay, so Antora is a really exciting company, and just by way of background on me and why like this particular one gets me super, super excited is before I was with Lower Carbon Capital, I was the Chief Sustainability Officer for the City of Los Angeles. And one of the things that, and that's decarbonizing a lot of infrastructure was my focus across the industrial sector, across the power sector, you name it. Antora is the type of company that is truly a like decarbonizing Army's dream, because essentially solving for decarbonizing industrial heat and also long-term energy storage, whether that is as for industrial sector or for power sector. So doing so by basically creating a thermal battery. This is long-term energy storage. We are used to the idea that storage is through the form of a battery, that is available for a few hours at a time, and that's mostly dedicated to the electricity sector, not necessarily going to offer a form of energy at the temperature levels that are needed to actually power the industrial sector. Well, so Antora is solving for that by being able to store clean energy in essentially carbon blocks, graphite blocks that are incredibly modular and do not take up a lot of space, and are able to hold that energy for and deploy it for 100 hours of industrial heat grade energy, and essentially being able to do that, work on the industrial base, and then eventually also working toward being able to provide long-term energy storage back to the power sector, back to the grid. So in terms of understanding that there is a market for this type of technology, for this solution, I mean, the market is vast, and the market exists across every geography. And so it's an incredibly exciting thing. And of course, we have to look at, how does Antora do against its competition? And that's the other thing we're really excited about, is because we just see it as a cut above the rest. I'm interested, Libby is also an early stage investor in Antora, how you see it. And David, hopefully, how'd I do?
Yeah, this investment was led by my colleague Christina Karapataki, and we were all really excited to see the team come in and excited to join the syndicate. So we led their Series A, and as Lauren mentioned, the technology uses electricity to heat blocks of graphite to extremely high temperatures, and to temperatures that are relevant for high-grade industrial heat, and then stores that thermal energy and then can transition it back, convert it back to electricity through thermal photovoltaics. And they can bring their technology to market in a number of ways, as heat, as steam, and as electricity. And we're excited about this because, well, for a number of reasons. Talking about customers and customer commitments, it's very adjacent to the energy sector, where we mentioned power purchase agreements and the impact that's had on bringing novel technologies to market. We see heat as kind of one click away from electricity, and something that off-takers may be familiar with and may be able to sign long-term off-take agreements. So technology has been very promising, offers a exceptionally high value to the industry by providing industrial grade heat and bringing it to market in a number of ways. The team has been excellent, successful entrepreneurs with a great track record, and then they've just now, by the end of last year, have installed their first pilot system, demonstrating hundreds of hours of operation at high grade heat. And then Decarbonization Partners joined to lead the next round. So the next step, who knows, may be project finance. So maybe we can complete the circle, but the next stage of growth, I'll let Kojo talk about.
Can we get a commitment here on stage?
We'll just sign the deal right here.
now.
What do you think? Come on up.
So at Decarbonization Partners, they've already kind of gone through technology. When we look to find companies that we collaborate with, one of the most important things for us is finding organizations that have multiple ways to win. And as you highlighted, steam, heat, electricity, they're not relying on any one of those things to be a successful business. And I think for me, outside of them having a really positive kind of implementation of technology, being exceptionally thoughtful, both in terms of deployment of the capital they have and also their growth plan, what's really important for me is that they're just exceptionally kind individuals. And he won't run away if you go talk to him. Like, they really super thoughtful, and they care about the planet that we're all inheriting and trying to be part of the larger solution. One of the largest source of GHGs is actually our industrial processes, and it's also one of the harder ones to abate. There are technologies that look at point capture where they'll actually go to the stack and pull the carbon out. That's super expensive. There are people working to bring those costs down. I think I'm certain those costs will come down. But what if you didn't have to, boil water to create steam? You could just source it from renewable power, and that's their solution. They source and create steam from renewable power. And so as we continue to see declines in the costs of renewable power, wind, solar, what have you, you no longer have to go down the path, well, let me go, burn some fossils to create steam. I can just take that electricity and turn it into steam. So really excited to work with these guys. We just came into the company in February. We are hopeful that this will be a very long-term relationship as we support their growth and kind of their ability to make the world a better place.
And just to understand, I think that's a really important point, Koja. Behind all of these innovations, there are people who are, ultimately at an early stage, we're investing in people, and Antora, but by definition, if you're a lower carbon company, we believe in you as people, and so we're here talking a lot about like the different colors of green, but this is really also about the companies that are winning are not only developing the key solutions that will power the future, but are really being built by people that are incredibly dedicated and incredibly savvy and incredibly thoughtful about that process in the meantime, and their relationships that they're building across the ecosystem.
Speaking of people, we're now going to move to the audience for some Q&A, and so I think there are some folks around the room that have microphones, and maybe as we get that gentleman over there who just raised his hand a microphone. Is that possible? There we go. I'll just note on Antora and this broader point about heat, clean heat, and industrial decarbonization, we were really pleased to feature Antora at our first industrial decarbonization summit in DC last year because we need more solutions like this. Koja mentioned the largest source of global emissions. 40% of global emissions is industrial emissions, and the majority of that is from the heat that is required to power heavy industry. So we need more solutions like this, and some of them are in some ways remarkably simple. I mean, who would have thought hot rocks, like literally hot bricks, was going to be our solution to that? But it turns out it works, presumably at tremendous scale. So it's really exciting. All right, we're going to come over to you.
Hey, all right, so IPCC models point towards that we need to be removing hundreds of millions of tons of carbon dioxide from the air by 2030, 10 billion tons by 2050. I really love what you're weaving in terms of power purchase agreements, early buyer signals. What we're seeing is that these companies are getting started, but there's a real financing gap in the very early stages. We're talking about like $100,000 checks, $1 million checks for companies that are sucking carbon out of the air. But what's missing is that long-term demand signal is certainly missing. The short-term demand signal is kind of there, but it's not there enough for investors generally to really go after it. I'm curious for all of you, what are you excited about in carbon removal for the next over the next 12 months?
All right, I think we're going to get maybe 2 more questions if folks have them, and then we'll come back to all of them together. Sir, here in the purple, just put up your hand here. You want to stand up and grab the microphone, or just shout?
I can shout. That's fine. Oh, never mind.
There we go.
Hi, my name's Johan, and I just had a quick question. In lieu of power purchase agreements, do LOIs from massive companies count in terms of consideration? Just wanted to know.
Yes, we're accumulating some good ones on demand signals and consumers. How about over there on the far side? Raise their hand. I guess that's by definition everyone on that side raised their hand. But this gentleman in the short sleeve shirt got his hand up quickly right there. Okay.
Thank you. Hello, I'm a future climate fellow here at the Aspen Institute, and thank you so much for your insights. I'm from India, and one thing that I see in the global south, generally with anything to do with climate projects is that capital is a big bottleneck. So I was curious to see if there are any thoughts on how your firms or just generally the industry is looking to invest aggressively in emerging and developing markets.
Okay, so why don't we take the questions on off-takes and demand signals for both CDR and clean power first? Who would like to address that one, their importance?
I think we'd probably all have different perspectives depending on the stage. We invest exceptionally early, and a lot of times it's just way too early for any sort of customer engagement, and that's not always the case. Sometimes there will be customers who are really pulling a technology through, but LOIs are impactful at an early stage. It shows that an entrepreneur can kind of work their way through the industry. It shows that they can build relationships and get feedback. That's really important. But the later you go, if it's not binding, it really does not substitute for an actual offtake agreement. But I can let some of the later stage and project finance folks speak to that one. Go ahead.
Yeah. I would say it's a huge signal and vote of confidence in the company, in the technology. But it's not as strong of a vote of confidence as someone saying, okay, I'm going to sign a 20-year agreement to purchase A, B, and C. And depending on who is underwriting the investment, that might be a requirement or it may not be. And so it really goes back to the stage and in that particular source of capital's willingness to take risk. But yeah, it's always a positive, just to what level.
Richard, do you have a thought on this one?
Yeah, so I agree with all that. I mean, the point on the LOIs is when all early stage companies, forgive me for going off script a little bit, because they always have a great innovative solution and a huge addressable market. Where they're really weak often is how they're going to get to the market. So that's the example. If you got an LOI, it means you figured out who might be interested in actually buying your product. But on the carbon part, carbon removal, that's really hard. You pick the hardest part of the market because deployment of a project requires the equivalent of a power purchase agreement. It requires a creditworthy counterparty, and it requires something that's long enough to pay back the capital and give a profit to the people that are providing the capital. And so unfortunately, we don't really have great long-term carbon, we don't have a great short-term carbon, we don't really have great carbon markets yet. So I wish I had a better answer. You want to? But I did want to go back to the point about the capital, because I think that, nobody wakes up in the morning saying that they want financing, right? And I think the problem that we've had with the whole, cottage industry of climate finance is people assume if there's only some kind of widget, we can unlock all this capital. I want to go back to the point that's come up in this panel. If you can create enough demand of creditworthy products with a stable, legal regime, there's plenty of smart people in the world that will want, and plenty of capital that will try to find a path to it. So the problem is not the unlocking the capital as though there's some problem with the capital. It's usually a problem with the projects.
Just to add on the carbon removal side, we are a heavy investor in carbon removal technologies, and so I think we see it as, look, long term, we know there is going to be a massive demand for carbon removal that way outstrips the supply that currently exists or is in the trajectory for existing. So, we are aggressively looking at what we think are really, the best technology, the best approaches, the most environmentally sound, the ones that the unit economics work out such that, they can be sold on either a voluntary carbon market or in other settings where, increasingly we're seeing whether that's federal government procurement, some states are doing carbon removal procurements, the EU is looking at a carbon removal target. So there's a lot of exciting, I actually think it's a pretty promising area of exciting pull, both from kind of corporate voluntary, and there's an opportunity to really grow that pool, all the way to a lot of public sector commitments. And this is really just a reminder, this is because the science is telling us that we have to remove carbon out of the atmosphere, even if we get to zero with decarbonizing existing operations throughout the globe. So that's a pretty weighty, a big weight to have on our shoulders. So we are looking at multiple different really exciting and interesting ways to do tech-enhanced nature-based solutions, and a lot of other types of carbon removal that are very, very new to the field, and there's a lot of interested parties. And the other thing I will say about that is, coming also previous background of the world of compliance carbon markets, the EU ETS, early days of the EU ETS, the California Cap and Trade Program, folks were conditioned to look at carbon credits as a cost suppressor for your compliance obligations in reducing emissions. That is not really the way carbon credits are seen these days. People are paying hundreds of dollars a ton for carbon removal because there's interest in priming the market, because they want to get out ahead. They've made really aggressive goals. And so this notion that carbon credits have to be cheap and not done well, I think we're sort of doing away with that, which is an area that we're really excited about and bullish on, and are determined that from a scientific imperative, we need to do it.
We're going to come to each of our discussants now for a lightning round final thought. And as you all assemble your 20-second final, incredibly insightful, encapsulate this entire discussion thought. No pressure, but just to give you a second. I'm going to just build on Lauren's point there. On the federal procurement side, to your question, we've seen really promising developments in that space. So the first federal procurement is now roughly underway at the Department of Energy, enabled by the bipartisan infrastructure law and some subsequent appropriations. Senators Collins and Cantwell now have the CREST Act, which would establish a long-term, you could think of it as a utility for carbon dioxide removal, which would scale over time to become a sort of an atmospheric waste management function funded by the federal government in the same way that we all use our tax dollars to pay for domestic solid waste management and that sort of stuff. And very interestingly, just the Sunday before last, the energy and water bill that was finalized in Congress had the very first just regular order $20 million program to begin to do that on a regular basis. And so once something's in those bills, it effectively never comes out of those bills. So now, over time, we're going to have today a modest but steadily growing effort at the federal government to procure this as a service, and to Lauren's point, it will be with very, very high standards. So strong permanent standards, strong MRV standards to set market signals and gradually drive down the price of very high quality CDR. So it's an exciting time for long-term offtake in that space. So with that filibuster, I'm going to turn to y'all for your final thoughts. Kojo, can I start with you for your final crystallization?
Yeah. So the challenge in front of us is quite immense. I often tell people that the engineers and scientists have done their jobs, and it's now up to us finance folks to figure out a way of helping these businesses grow. However, the biggest challenge, in my opinion, in my estimation, on where the bottleneck is stability, right? And so the policy environment continues to shift. And to the point that Rich made, this is a business in terms of the financing side. And so once the rules of the game are well established and there's less of a hesitation that the rules are going to change, the pools of capital will figure out a way to participate. And I think that's when you're going to see tremendous growth. And so the IRA, the bipartisan infrastructure law are amazing, but they can't be under threat. This has to be, this is the future. And then you will see people take advantage of it. People will come and really accelerate the opportunity that it represents and all the goodness that comes downstream of that as well. So stability is my word.
Great. Pete.
And for me, I think what brings all of this together and crystallizes the messages you've been hearing, whether you're an investor or an innovator, entrepreneur in this space, realize that your innovation is not only the product or technology or service that you're selling to your customers, it's also the company that you're building. And everyone needs to realize value if they're a customer of the corporate equity or corporate debt or project finance. So be mindful as you're building the company of those customers as well. And then also on the investor side, depending on the stage that you come in, be mindful of people before you and after you and of the teams. And it's really hard to get the balance right. But if we can get that balance right where everyone is realizing value, that will link all of these disparate pools together and kind of bring all of this to commercialization.
Lauren?
All right, well, I think we're all here because climate is good business. And we wouldn't have the many billions of dollars represented here with a pretty diverse investor base, I am sure, up here if that wasn't the case. So it's a very exciting time. Private capital often moves faster than public, and we need to move faster than the trajectory that we have experienced over the last few decades on climate tech and clean energy. And so even though you see all of us up here doing really exciting work, I don't want that to suggest that anyone in the audience can sort of like pull back and rest. This is actually a full contact sport with everybody. You can be an investor, an innovator, policymakers, I see, corporates, consumers. We all have to be pushing. Now is the moment, a real inflection point, that we all have to be super aggressive in making climate smart decisions in which any opportunity we have to influence and make decisions, because the market is responding that way, and the market is defined by many different things, and all of us have a very important role to play.
Richard, take us home.
Well, I think, again, it's deployment. We start with the things that are going to create demand in the market for goods and services that are sustainable. And if we do that, then it pulls everything, the demand, it's the locomotive which will pull everything else along. It will shorten the valley of death. It will bring in more and more capital, and it will draw in innovation. And if we've had mistakes in the past from a policy standpoint, is we've assumed a push model, and now we really, if we can all be aligned and think about it the other way around, that it's a demand pull market, we will be able to do a lot more quickly.
Please join me in a round of applause for our fantastic panelists. And thank you so much to the Institute for arranging this fantastic discussion. Thank you all.